Now we want to figure out how to scale tech companies. So plan and strategy are essential, but we do need much more. Several implementations, review, constant adjust are some of the concepts that for sure they are very familiar to you and you're going to have to deal with. Please, I want to welcome Álex Ferreiro, who is going to moderate the next session. It's actually going to be a chat, I guess, with Johan Kampe.
So hi, I want to start saying many thanks to Johan to come from London today, who's just arrived, and to share your insights with us about this asset class, this venture debt. So we structured the panel in 5 main key issues. That is the history of the asset class, also the strategy and the investment criteria. The market, the trends, also the collaborations with another equity funds and venture debt funds, and finally the role of the ecosystem. Let's start talking about your business, your experience.
Okay.
And
sure. Well, thanks everyone for joining us, and thank you, Álex, for inviting me. So my name is Johan Kampe. I am the founding and managing partner, I should say, myself and my partner, of Claret Capital Partners. We are a growth and venture lender, which basically means we're providing less dilutive capital to innovative companies. We have a European focus. I guess what's maybe relevant here, my partner and I, we've been in this market about 25 years in the tech financing space. 20 of those years working together, actually, in Europe. So we've seen a few things and tremendous growth along the way. Our current business, Claret, is 12 years old. It is institutionally backed. We're investing out of our 4th fund. We have just under $1 billion under management in sort of the main funds and a few side vehicles. Last year, we passed 1 billion euros in invested capital in companies. During that time, it's about 200 businesses. I guess we're London-based. Yeah,
So let's talk about the history, related with your experience, the history of this asset class, and also the key milestones of the years.
Okay. The sort of growth lending, tech lending market really started in California. Some people on the East Coast might argue that, but it was really driven by the semiconductor industry. I should have said it earlier. I was with Silicon Valley Bank, a bank everybody knows well now, early on. So I was with them from the mid-90s. And it and a few others were sort of born in the 80s. Really, as the semiconductor industry was growing, fabs, and there was a heavy need for something other than equity to build businesses. And there was also a whole host of leasing businesses on the West Coast, and that sort of started what became venture leasing and then grew into venture lending over time. And actually leasing, for those of you who are familiar with the industry here, is probably less of a feature. There's obviously leasing around, but it's become less important. But it really grew out of hardware financing. And that industry moved on, and players like SVB became big during the 80s and 90s, and in the US, the market was getting pretty saturated by funds and banks, and especially on both coasts, you would have had a lot of regional banks that do this, which are not worth naming, but just a ton of organizations, Comerica and others. Europe really comes onto the scene in about 2000, 99, 2000. I think one of our competitors would say that they set up in 99, which was EVP at the time. And it was really, really quiet. When I came over with Silicon Valley Bank to open the business in 2004, set up an office in London, and it was EVP, which is now which is now BlackRock, and us, and there was SVB, and ETV, which is firm I joined after SVB. There's 3-4 people. That's it. And the venture market was tiny, and you were running around kind of teaching people about the idea of using debt. And it was not very well understood. And what's developed over the years is, if we fast forward to here, I think it's in many markets quite understood and a quite well-used tool. What's also happened along the way is, the venture market has swelled. We look at the last 12 years or so, and it's grown 20 times or something like that. And along that, so has many other providers of both capital and other services, legal, debt, equity. And so now, I think what you have in Europe is quite a deep market. I think you wanted to talk about the market later, but with a lot of providers. And it's really transitioned from very hardware-centric to working capital, growth, funding. I guess I don't know if you have anything else on that.
I want to open the chapter in strategy and also investment criteria. Could you explain your investment thesis and also your track record in Spain with any examples of companies that you invest here?
Yeah. I guess high-level strategy first. For us, it's we're European focused. We have a little bit in other markets, Asia and the US. We're pretty wide in what innovative companies we back. So we would say technology. It's a lot of software, but we do marketplaces. We do some e-commerce. We have medical businesses, so we would do a little bit of biotech, but mostly medical products or diagnostics type companies. And then increasingly looking at other things like, maybe climate related, water technologies, power, things like that. With that over Europe. And sort of strategy-wise, what we're looking for, I guess that's part of your question, types of companies. For us, coming in, we're typically not the first investor in a business. We shouldn't be, being a lender. So typically our companies have raised 1 or 2 rounds, or have somehow gotten that far on their own. So we do some sponsorless companies, that are founder-backed or have customers that help support the early operations. But typically, by the time we get involved with the business, there's customers. The companies are not profitable, but there is, we can see that the products are working. We can talk to customers who can validate buying behavior and likelihood of sort of continued success, and those are important components for us. Coming in with that. Strategy, maybe just more, what are we looking for? When we actually look at companies at sort of high level, we again, I said we invest quite broadly, but we look at quite large market opportunities with teams that are proven. It's, when we look at across our deals, it's a pretty big dispersion of what the returns look like working with sort of more proven teams. Doesn't mean everybody has to be proven, but it's quite a big factor, especially if you get into adverse situations and you need to work out of them. And then I guess the other components of deals, so we want really interesting markets, good teams, some type of a moat in the business. I think that's really important, where either it could be actually a technology, like some type of let's say it's a chip and they have some really interesting IP, or it could be a very defensible market position. So if you're maybe more consumer products, what makes you unique there? What allows you to stay ahead in a market that otherwise really doesn't have traditional competitive barriers? And that's quite a tough area, I think. What else?
What are the main factors that you evaluate as a venture debt provider in terms of revenue, performance growth, investors?
So growth is very important for us. We usually say we're not a distressed investor, but we certainly end up there sometimes. And So for us, it varies by size, right? So if we look at a small company, we probably want to see 50 to 100% growth. Small being, a couple million in revenue or something like that. And then as that scales, the growth falls. But I would say, generally speaking, we're looking at over 25% growth at entry. And then that's growing into large markets. We want to see that the company is focused on. It varies by what they're doing, right? But a traditional software company, let's say, that's going to sell to corporates. What is their U.S. strategy? Let's say you're sitting here in Barcelona or Sweden or something. So it's really important, I think, for us to have kind of a global vision. Then, every now and then we would back maybe something more local, and that would have other constraints. But revenues, customers that we can talk to on stage. And I think, did you say it's syndicate as well? So I guess one of the other legs for us, I mean, we're oftentimes coming in after initial capital has been put into the business. And oftentimes are brought in by the early investors. And I think understanding the financeability of the company going forward is really important. So not only sort of where they fit in the market and what it's funding, I think you're going to come on to that later anyways, but how strong is the syndicate? Can they fund them? We're often asked, is that the only thing we care about? I mean, it was a pretty well-established strategy in the US when things were years ago. When I was at SVB, you could literally chase certain very early stage companies that were, let's say, backed by a top tier, Sequoia, Kleiner, whatever. And the chance that they would raise further funding was so high that you could pretty much blindly lend them money. And that's not really the strategy that we employ. We want to be able to understand the company and understand, where they fit strategically into their customers and so forth.
So now, trends and market, okay? What is the prominent trends that you see in Europe and also globally?
I think the trend is super good for entrepreneurs, right? I mean, everybody knows, and I mentioned it, but just how much the overall equity market has grown, right? So there's been a ton of money flooded into the market, ton of companies created. I assume many of you are some of those companies. And that has created a lot of other players coming in, right? And so what have we seen? We've seen, with all this growth in the market, you've seen a huge step up in competition. I mentioned there was 3-4 players when we set up SVB. Now we kind of stopped counting in our own competitive slides, but I think if you go out and look for funding, you could say that you have sort of funds and banks and foreign players and you have pan-European players, you have local players, both on the fund and banking side. So I think and then there's sort of product specialists, like sort of some of the revenue lenders. And I think what you have now is a very well-established ecosystem for sort of availability of alternative capital. You're also seeing kind of a growth in the overall industry. Raising money for a fund like this 10, 15 years ago, you're kind of caught between equity and debt. I mean, our return is a mix of debt and equity. It's sort of high-yield loans with equity components. And LPs were struggling to understand that. What's happened, the industry for, I'd say, alternative credit has really found its own footing. And now most institutional investors they certainly have a view, but most of them have a bucket. And it's a rapidly increasing bucket for alternative credit products. And some little piece of that is sort of venture and growth lending, and there's all kinds of other products as well. But it's really cemented itself as an asset class and something real that substantial investors can put money into, and that's very good for entrepreneurs. It's one more well-backed pool of capital. And you see, I mean, one of our competitors, and congrats to them, Kreos being sold last year to BlackRock is phenomenal for the industry. It's a real validation of what's happening, and that's sort of created a lot of other positive ripples. But yeah.
And what are the main differences between US and Europe, and is there any lessons that we can learn from US?
It's one of the, I mean, the real key difference is, which everybody knows, it's a bigger market and there's more players. I guess what can you learn? You can look at previous crashes or previous upswings and try to learn things. I would say, we're talking about debt and venture and what you can learn. If you look at some of the other sort of corrections and you go back 20 years to .com, we were very actively lending into then, e-commerce businesses and a lot of hardware. Optical was a very big part of the venture market then. And as the capital tightened there, it was a pretty ugly bloodbath. And so I would say, as it relates to venture debt, I would say those cycles and being in the wrong place when they tighten, debt, you have to be careful with that. It can be a very powerful tool, positively and negatively.
Okay, the macro environment was so difficult in the past years with inflation and also rising interest rates. So how these factors affect to the venture debt?
The rate environment has a clear impact. It is sort of a percentage-wise not as big as it might be in other, quite frankly, lower yield lending environments. So we run, I would say, kind of an absolute return strategy, and we're targeting, let's call it teens returns, where a heavy component of that comes from the debt. And you're lending it so high above kind of the risk-free rate. As the risk-free rate moves around or even doubles or triples, you don't get that multiple, right? You just get a slight correction. So if you look at how interest rates affect us, it moved by 100 or 200 basis points out of maybe debt being put out at low double digits. I think one of the impacts that it had on us in the industry is some of the banks that were much more sensitive to rates, their pricing moved around a lot more. And from a sort of competitive dynamic, the trade-offs in our industry between a fund and a bank is oftentimes, maybe there's more restrictions with the bank, covenants, but it's cheaper, and the fund is more expensive, but no covenants and more flexible capital. And that gap tightened quite a bit. The other thing with the rates moving up a few years back, obviously the equity pricing was impacted, and that probably had the bigger impact on our industry, where, as equity capital really tightened up, debt becomes an even more interesting alternative, right? Any alternative becomes more interesting when you don't want to face reality. And to your 2021 point, we also funded companies in 21, and some of them really struggled to put together rounds. They were built. They had a business model that said you could burn a lot of money, and capital would be available for you. If you kept growing and burning money, and then the music sort of stopped, right? And some of those businesses did really good jobs adjusting to that, and some didn't. Some we had to work very hard with, be very convincing, be very unpopular. Then sometimes it didn't work. But that's been probably the interest rates impact on our industry as the rates went up, probably the biggest impact. And we would have gotten a swell of deal flow of companies wanting to avoid the next round. That was a big feature.
Okay. In 2021, the valuations were extremely high. So what is your experience analyzing the companies that raised capital in that year?
Well, I guess that's a little bit what I was getting at. You mean once we're in those companies, what do you do? Yeah, that created a lot of work. Some of them I wish I wasn't in, right? And you had to spend a lot of time getting the companies to change. Some companies, and that's what I was saying, they were very proactive. Cut, burn, get profitable, whatever. And there was a large subset that said, no, we'll just keep growing. Cash is running out. You're flying against a wall, and so that was a lot of work, and I don't know what else to say. I think most people that have a wide portfolio, we have about 120 companies in our active portfolio, and some of them were in these sectors that were tougher. Created a lot of work. You work hard, roll up the sleeves. Restructuring, yeah. Okay, let's talk about the relationship with venture capital funds and also venture debt funds. How do you manage the relationship with other other venture capitals, and to complement equity rounds with venture debt? So we get about 70% of our closed investments come from an earlier investor. that's usually kind of an institutional VC, but it could be an angel or family office or something like that. So oftentimes somebody backs a business day one and it grows, it gets customers, and then they want a lower price point on the capital, and they find us and our competitors. So it's an extremely important source of deals, and it has been for a long time. And there's people that say that these automated lenders will change that, but at the moment, that's still what our sort of closed business looks like. So we spend a lot of time in the ecosystem, not just trying to sort of suck deals out of earlier investors, but also trying to put back. We've been in this business a long time. We have networks, so we're sending companies both ways and so forth. It's a very active engagement, I would say, and I would say the industry, not just with sort of a venture capital firm and a lender, is quite collaborative. We work pretty close with some of our competitors. Sometimes you're competing head-on, and sometimes you're sharing deals. I think about a third of our transactions in our fund we do with another provider, just like VCs. Maybe we'd share an equity deal. We share, and sometimes it's a bank taking a more conservative strip and us taking the risk strip, or sometimes just sharing deals. We closed with BlackRock a $75 million deal just as co-lenders recently. So I would say the industry is quite collaborative. I think that's also another benefit to the companies. It's become more so the last few years, and I think that benefits the companies. It helps you guys raise, scale with the syndicate also in your lenders, and I think that's an important thing to think about just as you contemplate debt. How you can grow with the lenders you have. Switching gears kind of halfway through can be quite expensive and time-consuming.
Yes, what advice would you give to the entrepreneurs between raising capital, raising venture debt? In particular, it depends on the stage of the life cycle of the company.
So I would say, first of all, I would just say it's not one or the other, because we get a lot of companies that kind of say, okay, well, am I going to do debt or am I going to do equity? And I think the right thing for the right company is probably a mix of the two. It saves you, a fair bit of dilution if you get it right, which I think is important to anybody who cares about their company. I would caution companies to take debt too early. Everybody sets their own benchmark, both, I guess, from a company standpoint and the lender standpoint, when that is. We tend to, think about that as reasonably early, but still kind of revenues that we can dig into, and as I said earlier, talk to the customers, kind of understand what we think is going to be the buying behavior. Probably not a bad starting point for a company, because what you don't want to do is take on debt, kind of miss your, let's say you're trying to launch a product, so you don't have revenues, and you miss that, and then you've got to do a tough round, and then you've got a bunch of debt in the business. That's, like, generally speaking, a pretty ugly picture. Not always, but pretty much. So I would say there's really interesting ways that you can use both tools. They both have their place. I would be very cautious for rushing into things too early. I'd also say there's lots of different ways to borrow money, right? There's kind of term debt, which is a lot of what we and other funds do. There's revenue lenders. There's banks that do working capital. There's lots of solutions to look at. I guess one thing, I would also think about, just because it's the cheapest doesn't mean it's going to be the best or long-term cheapest for you. So, a cheap line that doesn't work well is probably not as cheap as maybe a slightly more expensive and flexible facility. And I would say pick the right partner from, not just the money standpoint. What commercial things can you get from them? Network introductions. We spend a lot of time helping our companies, and I would dig into, just like you would with an equity investor, what can you get out of your partner on the debt side?
So finally, the last question, the role of this asset class in the ecosystem, how venture debt contribute to growth and scale tech companies in Spain and Europe?
I think it's just part of a growing system, right? There's a ton of money coming in, and the whole market is growing with equity and debt. It's one component that gives entrepreneurs a tool to finance their business. It's not that complicated. And we specifically, as I just said, we spend a lot of time trying to put something back into the ecosystem with our networks, connections in the U.S. and stuff. But ultimately, it's just debt, and the development of debt generally is just another tool for entrepreneurs. Yeah.
Okay, thank you very much
Thank you.
for staying today with us. And we are seeing a consolidation of this asset class, and I am sure that Spain will play a key role in South Europe. So thank you very much, Johan, and all the audience.
Thank you.